Hi, in this video I'm going to focus on process costing, and this video is dedicated to all students who are doing ACCA F2, which is management accounting. I've already uploaded a video on process costing which is for those who are doing CMA. So process costing, the way it is done for CMA exam and ACCA is different. So this one focuses on the ACCA syllabus. Hi, if you're new to my channel, I'm the commerce specialist. I create content covering learning outcomes of various academic qualifications and professional certifications, including life-changing business ideas and hacks. So humble request, if you're not yet subscribed to my channel, please subscribe my channel, press the bell notification button so that you get my videos on a timely basis. Thank you very much. Let's begin with process costing. When we talk about process costing, we are talking about units which are processed not in one manufacturing process but a series of processes. That's how it got its name, process costing. So when you start process, maybe it's process 1, you start manufacturing. Once process 1 completes the job, it transfers the goods to process 2. Process 2 further processes it may go to process 3 and 4, and finally you arrive at the finished goods. But here, especially for ACCA F2 management accounting, the type of questions you encounter in exam, I'm focusing on them. So here we have a question. It says input means you started production with 1000 units. There is a normal loss of 10%. What is meant by normal loss? Normal loss is the expected loss, which the management is mentally ready that this much they may lose. Let's suppose you start production with 1000 units, as in here. Normal loss expected is 10%. That means 100 units you will be losing as a result of process. So if you start with 1000 units, 100 units you're mentally ready, because experience tells you, you have historical figures that every time you start off with 1000 units, 100 units would be lost during the process, and which is very normal. So let's see how we tackle these type of questions where there are normal losses. But please remember, in the end of all process costing questions, in the end you have to calculate the cost per unit. Whether it is process costing, job order costing, this costing, that costing, in every costing method, in the end you have to calculate cost per unit. Same is the case with process costing. So in a question like this, what we do is we start off with input, which is given to us as 1000 units, less normal loss, which is at the rate of 10%. So 10% of this would obviously give you 100 units. So if 100 units are lost in the process, you are left with 900 units. This we call as expected units. Expected units, 900 units. And if you look at the actual output is also the same. Okay, so if you want, I can do the expected units less actual units, which is also 900. So there is nothing now. First step, you start with your input minus your normal loss. This expected unit is very important. Actual units are also the same. That means there is no discrepancy. Your estimation of normal loss was correct. Second step is to calculate cost per unit. Cost per unit, the formula is very, very important. You are given production cost, which includes material, labor and overheads, which is $90,000. Your production cost is $90,000, and you divide it always by expected units. That's why I told you this is very important. So when you divide it by 900, you will get $100 per unit. What is this? This is your cost, 100 per unit. Once you got cost per unit, what you're supposed to do is you have to prepare a process account. Process account is made in memorandum form, which means there will be 2 columns here on the credit side, and there will be 2 columns here on the debit side. One column is for units, the other is for the amount. Here also units, and the other is for amounts. This is your process account. So you always start from the debit side with your input. You started off with input, that means these are the units you put into production. 1000 units and it cost you 90,000. That's your production cost, right? So what happened to this 1000 units? You're going to show it on the credit side. Out of this 1000 units, you incurred a normal loss of 100 units. Please remember, we do not give any value to the normal loss. Then we have finished goods. We are assuming this is the first and the only process. Finished goods are priced, are calculated. Finished goods are valued at $100. So we are saying at the rate of $100. How many units are there? Expected output and actual output, 900 units. So these are 900 units. If you multiply by 100, you will get 90,000. So when you add, this is 1000 units. And this is also 1000 units and 90,000. This was a very simple process costing question in which you started off with 1000 units. There was a normal loss expected, which was 10%. Okay, so 10%, when you minus normal loss, you get expected units or expected output, which is very, very important. Why? This is what you use in the denominator when you're calculating the cost per unit. It is the process cost divided by expected units. Please remember. Now I'm moving on to question number 2. So in question number 2, we have input, we have normal loss, we have actual output, process cost, and we are supposed to prepare process account. We will start with input. 10,000 units. There is an expected normal loss. Normal loss is expected at the rate of 20%. 20% of this will be 2,000 units. So always minus normal loss. You will get expected output, which is very important. Expected output, 8,000 units. Obviously, if you're starting off with 10,000 units and normal loss is expected at 20%, so you are mentally ready that out of 10,000 units, 2,000 units will be lost in the process and we will be left with 8,000 good units. But what happened, you have actual units. Let's say it is 8,000. Your actual units are 7,000. That means your actual production is less than what you are expecting. From 10,000, if you minus normal loss, you should be left with 8,000 good units. But you had only 7,000 good units. That means you're losing 1,000 additional units, which was not expected. And this is called abnormal loss. Let's say you carry crates of eggs from one place to another. That is your business. So you load your truck with crates of eggs from point A to point B, you transport them. Every time you transport, if you're carrying 100 crates, 10 crates, which is 10%, are, something happens to them and the eggs are broken. You're always ready for this much loss. You're mentally ready for that. But one day what happened that you were on a signal and a car came and that car banged your truck from the back. Out of 100 crates, not 10 crates, but 50 crates were lost. Is this what happens every time? No. This is something which is unusual. What is unusual is not what we are mentally ready for. So that is called abnormal loss. If there is abnormal loss and normal loss, how do we calculate cost per unit? Please have a look. When we calculate cost per unit, the formula is actually production cost divided by expected output. So your production cost here is $40,000 and you divide by expected output, which is 8,000. 8,000 units is your expected output. So as a result, you will get $5. This is your cost per unit. Obviously, you are asked to prepare process account. So let me make it here. Process account. Okay. So by now you know there are two columns here and two columns on the credit side. One column is for units. The other is for amount. You can write units first or amount first. It's up to you. So always start with input. Input is how many units you started off. So your input was 10,000 units. And on these 10,000 units, you have spent 40,000 to produce them. This is your production cost. What happened to this 10,000 units? So out of these 10,000 units, normal loss was for 2,000 units. Normal loss for 2,000 units. As I said, we do not attach any value to normal loss. Then we also have abnormal loss. Abnormal loss are also valued at $5, which is valued at $5. So abnormal loss figure is 1,000 units. So 1,000 units were abnormally lost, and the value of this is 5,000. Your actual output is 7,000 units, which you can call finished goods. These are also valued at $5. Okay, so 7,000 into 5 is 35,000. So if you look at this, 10,000 units we have on the debit side and 40,000 is the production cost. You go on the other side, add 7, 8, 9, 10. You have 10,000 units here. Okay, and if you add, this is 40,000. So both the sides are balancing now. So what happened in abnormal loss? You start with input, you minus your normal loss, which is expected loss. You get your expected output. This much output you were expecting that even after normal loss, you should be having this many good units, but your actual output was 7,000 units. So if your expected output is 8, but the actual is 7, that means some units are lost abnormally. We call them abnormal loss. Now you would be thinking, why are we attaching a value to abnormal loss and not to normal loss? Please note that abnormal loss is a loss which can be claimed for insurance. So if our goods are insured, we can claim our abnormal loss from the insurance company. And when we claim our loss, they will always ask us, what is the value of your loss? So we lost 1,000 units abnormally and they are valued at 5,000, and this is the amount which we want to claim from the insurance company. But when it comes to normal loss is a loss for which insurance claim is not possible. So let me give you an example, and this is a real life example. Once I purchased a new car. I parked my new car, and what happened, somebody just put a slight scratch on my car, on the door of my car. So obviously it was a new car and I was worried. So what I did, I called the police. I told them, look, somebody has put a scratch on the door of my car. So the police said, look, for a scratch, we cannot go and catch that person, even if you know who has done it. So I asked them why. They said it's a non-cognizable offense. Means this is a mischievous act. So for that, we cannot just put somebody behind the bar. So what I did, I called the insurance company. The insurance company guy was my friend. So I just called him. And I told him, look, this was informal talk. I said, look, there is a scratch on the door of my new car and I want the insurance company to, replace the door because I don't want to repaint the door. It doesn't look good. You would not be able to match the color. So you know what they told me? He said, look, because it's a slight scratch, the insurance company will not, replace the door. I said, okay, if this is the case, what I did is I kicked twice, thrice on the door. I damaged the door very badly. And then I asked my friend, will the insurance company replace the door? He said, yes. So this is just between you and me. And this was an informal talk I had with a friend. So what we did is, then I reported formally to the insurance company that my door is, damaged. They replaced it. Why? Because the scratch for insurance company, it was a normal loss, which insurance company is not taking keen interest to, make it good. But when it is very damaged, it's an abnormal loss. Damaged doors are not normal. So that is covered by insurance. And whenever we claim, we need to know the value of our abnormal loss, which is 5,000 in this case. For normal loss, what we do is, yes, normal loss, we are losing something. But what we do is, the cost of the normal loss is spread over good units. So let me give you an example. Let's assume you purchased 10 goats each goat for 1000. So what is the total cost of the goats? 10,000. Okay, you purchased 10 goats, one goat for 1000. So total cost was 10,000. What happened? One of the goat died. So now you're left with 9 goats. If you sell these 9 goats for 1000, you will recover 9 into 1, you will recover 9,000 as your cost, but the actual cost was 10,000. So what you're going to do is, because one goat died, you're left with 9 goats and your cost was still 10,000. So what you're going to do is, this total cost is divided by the goats which are alive. Alive goat means the good units. So when you divide 10,000 by 9, obviously it will come more than 1,000. So if you want to cover all your cost, what you will do, your total cost you spend on buying the goats, 10 goats is for 10,000. Now that you're left with only 9 goats, you will be selling 1 goats at a higher price, higher than 1,000. So when you divide this will give you like 1,100 and something, which means your good goats, when you're selling them, you sell them at a higher price so that you recoup the loss on the goat which died. That's why here normal loss is not given any value. In fact, if you notice here, your production cost, this production cost was for total 10,000 units. 1,000 units, 2,000 units were lost. So when we calculated the cost per unit, it is 10,000 by 8. That means the good units. These are the live goats. Okay, this was the normal loss. So the total production cost we are dividing by the expected output, the live goats. We get 5. So normal loss is not given any value. Abnormal loss is given the value. Finished goods which we are actually selling, this 5 covers the loss of normal loss. This 1,000 also covers the loss of normal loss unit. So this $5 covers normal loss, whether it is calculated for abnormal loss or finished goods. So this is how abnormal loss is recorded. Process account is made. Normal loss will not be given any value. Abnormal loss will have the same value as cost per unit, and finished goods will also have the same value. Coming to the last scenario. In the last scenario, what happens? There is a possibility that your actual output is more than your expected output. If you focus here, your expected output was 8,000 units, but your actual output was less. So we have abnormal loss. Let's see what happens in question number 3 when your actual outputs are more than expected output. So in question number 3, you start with input as always, 30,000 units. Your normal loss is expected at the rate of 15% of 30,000. That would be 4,500 units. When you minus, it will be 25,500 units. This is your expected output. But if you look at your actual production, actual output, which is 26,000, so your actual output was 26,000. It's a kind of a miracle. Your historical figure shows that if you are putting in 30,000 units for production, 15% of the units will be lost as normal. We are mentally ready for that. So if that happens, we are expecting our actual output to be, the good units to be 25,500. But here, the good units are more than that. How much? 500 units. This 500 units are called abnormal gain. Just as we had abnormal loss here, because our actual units were less than the expected output, so we lost more units. Here our actual output is more than expected output, so we have abnormal gain. Here again, we will calculate cost per unit. Cost per unit. The formula is production costs divide by, again, expected output. So this expected output is very important. So your production cost in this question is 25,000 and your expected output happens to be 25,500 units. So this is $25,000 divided by 25,500. You will get 0.9804. When you make the process account, It's a little different here. You have two columns, units, dollars, units, and the amount. So you start with input. We are talking about 30,000 units you started off with. And the value of this is $25,000. This is what happened here. Here, there was some normal loss. So normal loss is how much? 4,500 units. And you know that we do not attach any value to this. Our finished goods, which are actual output, is 26,000. So these are at the rate of 0.9804, 26,000. So when you multiply 26,000 by this, you will get 25,490. Abnormal gain which you have will be recorded as a debit side. We're calling it abnormal gain, 500 units. And obviously when you multiply it by the same value, 0.9804, you will get 490. So when you add, you get 35,500 and this is 25,490. Here also when you add, you get 35,500 and this is 25,490. Here a note of caution I want to tell you. Sometimes in examination, there is a scrap value for normal loss, which means the units which you have lost normally, you can sell those units at a throwaway price. So if there is a scrap value of normal loss given, everything will be the same. The only thing is when you're calculating production cost, from this production cost, you will minus the scrap value of normal loss. Let's say a normal loss units are 2,000 units and that could be sold for $1. So from your production cost, which is 40, 2,000 into $1, you will minus 2,000. Whatever you get, you divide by expected output, you will get cost per unit. Sometimes it is also possible that when you have normal loss, instead of giving a scrap value, you are given a cost of disposal for normal loss. You have normal loss units, nobody is willing to buy, you have to pay somebody some amount to get rid of them because they are occupying space. So if there is a cost for disposing of normal losses given, so what you do here is, in the production cost, you add the cost of disposing the normal loss. So obviously production cost will increase, but you divide by expected output and you will get cost per unit. Ladies and gentlemen, if you have any issues relating to normal loss, abnormal gain, please do leave a comment. I will reply to you as usual. So guys, if you're not yet subscribed, please subscribe my channel. That's how you show that you value my work. If you like this video, please share it with your dear and near ones so that others can also benefit. Thank you so very much for your precious time. Love you all.